Hi, I'm Howard Lindzon, general partner of Social Leverage and host of Panic with Friends. And today I'm panicked about panic. Okay, Knut.
Hey, Howard.
What are you panicked about?
I'm panicked about my upcoming trip to Europe and what I need to do to get in.
Wait a minute, I'm going to Europe. What do we need?
I don't know, different for every place. Sometimes you need a COVID certificate that says, you have had these shots. Sometimes you need a test to show that you don't have any COVID in you right now.
Uh-huh.
I don't know, which country are you going to?
I'm going to Italy.
Yeah, what was it like last time you went there?
No, not much. You landed in Florence.
They just
not much security.
Let anybody in.
I mean, when your economy's worthless, there's nothing to steal.
Right, no, yeah.
I say that with much love to my broke Italian friends.
Yeah.
You are listening to Panic with Friends. Today, my only friend, because everybody's broke, is Knut. And I figured at the end of the year, we just, you and I chatted, and because the markets are in turmoil, it's, where are we? This will air next week. This is kind of not an evergreen show, but it is kind of like our first real panic since March 2020. But back then we were doing daily shows. In the spirit of no, I would never do another daily show. And we were chronicling one of the great panics of it will be of our lifetime.
Yeah. Because
the world had shut down. So I felt it was important that we do the show and we have a time capsule and we kept our cool. This panic that we are in right now is very focused on a specific group of companies. We'll get into it, but it's mainly focused on companies that are doing well. They're just overvalued.
Right.
And they're all dropping at an accelerating rate. There's no reason to panic because these companies are not going out of business and the market is not, in my opinion, in any trouble. But markets do what they do, and there is panic. And so I wanted to just sit down with you and have you ask a few questions, mainly questions that people are emailing us, and you went through them and picked a few questions that we can answer. I did do a podcast with Odd Lots, which I'll share in the link to the show, which is about 45 minutes. And Joe Weisenthal at Bloomberg and Tracy Alloway really dug into a lot of the questions that I'll quickly get here, but this will be with better sound. And they were asking, I think it was a good interview. It's controversial, supposedly, just because I was a little bit negative on the industry and valuations and behavior. But I think it was a pretty good interview from overall 90% positive. People appreciated the feedback. So I'll share that in the links. But let's get to the markets, Knut, and give me the three things that stand out from questions. What do we got?
I got three questions here. Yeah, one is the Great Roundtrip and what can we learn from that? And after that, we'll get into the markets and ask if they are as connected as you thought. And then at the end, we'll check on what excites you here.
Okay, that's fair. I mean, excites me physically or in the market?
I'm not sure.
I'll answer both.
Yeah.
I just went to the bathroom and you guys all wished me well.
Yeah,
I felt that was rude.
No,
because you're implying that I may keel over at any moment.
I'm thinking about your prostate problems, man.
By the way, I have a Whoop.
Good for you. What is it?
It's saying quit. Saying take me off. Saying you're bad for business, as my Whoop has said. This product was not meant for you. This has been a very difficult thing to set up. I know I'm technologically an idiot, but for any Whoop employees listening to me, and I know they are, I have a lot of questions. So hit me up. So what was the first
question is, the Great Roundtrip, what can we learn?
Oh, the Great Roundtrip. This is something that I've written that has gotten a lot of, actually, Wall Street Journal and Bloomberg have picked up on this. It's kind of, you write all day and every day, and occasionally you write something that catches. And so Great Roundtrip is something I notice in a chart pattern, which started in when we started our show, but March, April, May, June of 2020, and is coming to full fruition now as we speak here in February 2022 is stocks that took off the fastest, save Tesla, which has just done incredibly well even through today, but save Tesla, maybe Apple and Google, but every other tech stock that shot out of the, and Microsoft, that shot out of the gate when we realized we all weren't going to die. Peloton, Square, PayPal, Etsy, Shopify, Zoom. I think I said Peloton, but why not? Because they've done so poorly.
Just say it a few more times, I think.
Robinhood have round trip, meaning they're basically back to where they were in February of 2020.
Yeah.
And so this chart pattern just looks the exact same. Whoop, whoop, sound effect. And the poster child for that great round trip is ARK Invest, Cathie Woods. They loved her in the media in January, February of 2021, and now it's a running meme joke. And she was never that smart, and she's not that dumb. She's just another money manager who the media decided was great, and now we are making fun of her. Well, I am, but a lot of the people are making fun of her because she's not Warren Buffett. So this great round trip, if we look back at it and assume the stocks that I mentioned are now back to where they were in February, March of 2020, well, what do we see from that pattern? Obviously, FANG, for the most part, stayed intact. Facebook and Netflix are struggling, but Microsoft, Apple, and even Amazon are holding in there, if not doing great. And Tesla has emerged as a new FANG. Maybe you take Facebook out and call it Tang. Maybe you add, Tesla's basically the only, and maybe NVIDIA. But save those, everything else is starting to look the same, whether it's cloud or e-commerce. And so what I want to focus on, and I'll say this right now, is the great opportunity. So what we might have had coming out of COVID is just a giant head fake, the move before the move. I'm hoping this, and we can't bet on this, but this great round trip has led to what I would call another great opportunity, because everything went up together, and now for the most part, everything's coming back down together in tech. And what's working right now as tech pulls back, we don't have a full market crash. Coal's doing well, oil's doing well, energy stocks are doing well, gold is breaking out. So the markets aren't disintegrating.
Isn't this just life coming back to some normal that we're seeing here?
Correct. Well, I don't know if it's normal. The markets on a day-to-day basis are not normal. On a long-term basis, yes. Asset allocation is what's coming back in mind. You can't just own 100% tech stocks. It looked great for 9 months, 10 months after the COVID scare. And this great round trip is now level setting tech again, saying, okay, you had COVID, but let's be honest. Peloton and Zoom are different companies. They might have both gone up, and Square and Robinhood. They might have all gone up looking the same and come down looking the same. But now that the great round trip is over, which companies are different? And that's the market, right? They occasionally move together, but the great investors find the companies that emerge from these patterns that are different than the others. So if I were to pick some companies that would emerge from this great round trip, I'm very focused on e-commerce still. I'm very focused on the cloud, as people know. So some companies that look like they will come out stronger than ever, unless there's some fundamental changes that we don't know yet. But as they all go up together and come down together, I'm focused on companies like Cloudflare, Shopify, and even Zoom. And what makes them different, in my opinion, is the focus of their businesses, the three that I pulled out, right away. They have high margin businesses. Zoom is not shipping bikes. No matter how open the economy becomes, Zoom is entrenched now. They have huge competition. That is what we're seeing from Microsoft with Teams, and we're seeing that from Google with Google Hangouts, and we're seeing it from everybody getting in the video business. But that's a good thing because the TAM of the video space is huge. And so while people may go back to work, I think there's a double possible effect long-term for Zoom, is they onboarded all these new people. Zoom was not a verb. Zoom was not something people use. People didn't know how to use it. Kids definitely didn't know how to use it. And no matter how much Microsoft Teams and Google Meet competes in new products, Zoom works. And it's an 8 to 80 brand, and the margins are great, and customers were pulled forward. They don't have to ship hardware. And even if people stop using Zoom less, they still charge the same per month. So actually their costs would theoretically drop while their revenues stay the same and grow. So there's all these factors that I think might make Zoom, once we come out of this great round trip, better. The same goes with Cloudflare. We've had Michelle and Matthew on the podcast before, and we'll have them on again. But in a world where cyber matters and speed matters and the cloud matters, Cloudflare is emerging as one of those great companies that will be around for 10, 20 years as a leader. And then third on my list there that I'm watching is Shopify. It's doing a round trip like everyone else, but it's still well above the round trip number. So relatively, it's strong. Technically, it's as weak as all the other great round trippers, but as a platform and as a company that's benefited the most from this COVID tailwind, and in a world where everybody wants to be in business from themselves, I look to a platform like this as one that when this great round trip is over, will reemerge as another leader. So I look at this great round trip as an opportunity. It's a mess. It's a lesson to people that stocks don't just always go up and to trim on the way up so that you can buy sometimes great companies when they sell off together. So that is what the great round trip means. Hopefully that helps people. Next up.
So are the markets as connected as you thought?
This is a great question because this is what I spent most of the Odd Lots podcast talking with Joe, who's fascinated by this, because I believe they are very connected and they were acting as such very well until the last year or so, meaning the markets were getting more connected. And by that, I mean private markets were acting more efficiently than public markets. So a lot of the public money, including mine, started going into the private markets because we felt that there was opportunity. And that was working, I felt. Like, private markets aren't for everybody. It's harder work. It's longer time frames. There's greater risk. And it felt like there was great rewards for taking that risk. And even at Social Leverage, we've trounced the QQQs with our returns over the last 10 years. So maybe it's not that we're smarter. Like I said, the private markets, the software and cloud private markets offered better returns than the public markets, as they should, because you're taking more risk over time. But over the last year, it's been baffling, at least over the last 5-6 months, to see the public market equivalents of what we're investing in the private markets sell off 50, 60, 70%, but have the prices in the private markets continue to go up. So the range is shrunk, like to the point where I'm, as I was saying, if someone pitches me a Zoom type product, I'd rather just buy Zoom, the public company, not because there would be greater returns, but for the risk return that I'm taking, I would rather own the liquid version of the next Zoom competitor in the form of Zoom than taking that risk in the private markets for 7 to 10 years. And that disconnect is something that I didn't see. I thought that the private markets would correct much faster, meaning if you see Zoom down 50%, then all software cloud video type startups would be down 60% or 70% because you're taking more risk in doing it. And what we've seen instead is no movement in the prices of startups. And so there's a bigger disconnect than I thought. And it's important that I talk about it because I'm trying to think through why. One of the reasons, Knut, could be because there's so many new investors that came into the market in COVID, leaving a great company to start their next company, or being in a high growth company through COVID, DocuSign or Robinhood or Plaid or Square or Etsy or Shopify, and then now leaving to start a company. And you only know that you don't even know the public markets, what they're doing. You just know that you worked at a rocket ship and that this is what other companies are raising money at. And you haven't even factored in what's really happening in the markets. So I think that's what's going on. And if that's what's going on, what we will see quickly in the next month or two is a really fast, nasty correction in the pricing of private companies that adjust to what's happened in the public markets, which would make me feel better because it would mean that I'm not crazy, or, which I think is less likely, Zoom doubles in the next 3 months and everything goes back to silliness and prices go to the moon. But I really do think, Knut, that this is an important moment because we are taking, when we invest at a seed stage level, we're investing for 7 to 10 years. So price does matter. And for about 10 years, it didn't matter. Mm-hmm. So this is a really interesting moment in time as people learn how connected markets are. Because right now I see too big a disconnect, and I do think it'll correct very quickly in my world, private world. But if not, it just prolongs some kind of agony that's out there. Because eventually these are connected markets. People have to act as if. And the only defense I have against that right now is sitting on my hands, which we're doing. That's what I'm advising people to do, is like, until things make a little more sense, take less risk. And so hopefully that helps. So that was question number 2 about connected markets.
Yes, and the last one is, what excites you here?
Yeah, I mean, like I said, the public markets have my attention because we are really at some kind of change of trend over the last 5 or 6 months. And we don't know how long that will last. So energy relative to tech is in some kind of pivot point. Like for years and years, tech has so strongly outperformed energy as a ratio that energy became so small a part of the S&P. So it just kept doing worse and worse because no one owned it. And then since no one owned it, no investment happened in energy. So I think the biggest, and I wouldn't say excitement, but the biggest thing that I'm concerned about, other than do private markets correct to the public market counterpart, is this a giant last gasp energy fake out? Because we know on the other side, if energy prices stay high here and Exxon's at all-time high again, and oil's, I don't know, 90 or $100 a barrel in Russia, Ukraine, and blah, blah, blah. We don't know who's pushing which buttons, really. We're all just peons. But we know that if energy stays up this high, tech will win, meaning carbon, neutral stuff, technology. The longer this goes on, the worse it becomes for fossil fuels because tech is focused on this now. Mm-hmm. So the only question is how painful and how dangerous is this move in energy to the world? Because this is the last gas. They are going to figure out in the next 20 years how to get rid of carbon with nuclear, whatever it's going to take. Because if prices keep going up in energy, the world's not in a position to pay these prices. The inflation's out of control. So I don't know if it excites me, but this is the biggest issue. Is this the last super spike in oil, or is it just one of another of thousands, which is fine, and we should... While everybody chases energy here, technology will win the day and people will stop spending and the economy will shut down and oil will drop again. But I don't see that happening. I think what's really important here is this the last big gasp of fossil fuels? And you can't predict how long this spike goes on. And I remember having Alan Schur on when oil went negative, and I was just talking to him today about this, and he's going to do some research on it, but he's not bearish on energy at these prices, but like he's seen so many of these cycles, it's not like he's super bullish. And but I think something has to give here. And right now we've hit that point, Knut, where tech stocks are not 1999. These are great companies with great cash flow. I just think they were massively overvalued and everything's getting repriced. So this is an important moment for the markets. I'm hoping that the private markets cool down a little bit and take heed of what's happening in the public markets so that returns can go accordingly to the amount of risk that you take, so that private market returns rise to a level that makes it interesting to invest in private markets so that cash doesn't sit in the sidelines. Like for people like us, we want to put money to work, but I'm not going to put money to work on behalf of LPs if the returns aren't great. If I don't think the returns are great, I'm just not going to do it because I'm paid to make money, not just to put it to work. And even though some people would argue that that's not true by venture capitalists, I do believe there's enough professionals out there that like to make good returns and aren't just investing money to put money to work. And that's the big concern I have. How long does that go on before professionals decide that these returns don't match the risk? And in the public markets, it's doing its job. Like Zoom is not going to zero, but it still could be overvalued at $130. So at some point, it's going to stop falling because people will say, well, this is an incredible company, and at $25 billion, I'm putting my whole amount of money in that because I know it's a $100 billion company. But 6 months ago, it was a $100 billion company. So, obviously, people had this stuff priced wrong, and the beautiful thing about public markets is they're working again at some level. So pretty amazing, interesting time. Does that help at all, Knut?
Yeah, it really does, actually. Yeah.
So hopefully I wanted to get this off my chest because it is a confusing time in the markets, because if you just looked at the indexes, you don't see any problem. If you're in the energy business, you're loving life right now. If you're in the coal, you can't believe what's going on. You're trying to hire people and people were like, what? Coal's in business? Get the oil rig ramped up again. I thought we figured that wasn't going to work anymore. So we're at a dangerous point. And then we have the saber rattling, which seems to always come when there seems to be no reason for it. And politically, I just way over my pay grade here. In Norway, because of oil, what are you saying? Are people just joyous in the streets with oil at $90?
Well, the Norwegian economy is really dependent on the oil. The whole social democratic system is dependent on that income. Now, we got to remember that oil is not only fuel. It also produces the plastic on your dashboard of your car. It's used for lubrication. It's used for a lot of things other than pure fuel. So that industry will never die completely. Otherwise, we'll have to go back to making cars out of wood.
Yeah, good point.
And steel.
Yeah.
So there's still going to be a market. Now, how big it's going to be, who knows?
No, but I'm saying, are Norwegians secretly happy about this stuff?
No, I don't think so.
Well, I think so. So am I wrong?
I don't know who's right and who's wrong.
Well, let's put things in perspective. Our good friend Hans, a tribute out to him, his father passed. We're at the age where people are starting to pass away, Knut.
I know.
My partner Tom lost his dad last year to COVID. We've got our friends losing parents, not just from COVID, from other
all kinds
things.
of stuff, yeah.
So let's keep that stuff in perspective. My buddy, one of my LPs called me, his friend passed away on the golf course a couple weeks ago, just from a stroke. So we got to have some balance out there. But at the same time, this show is about trends, and I felt it was an important moment. I do hope we don't get to that point where I got to do kind of a daily panic diary. But at the same time, Knut, I felt it was important to just kick off a guest and get this under our belt. So you are listening to Panic with Friends. I'm Howard. That's Knut, Canadian and a Norwegian, talking to founders, venture capitalists, traders, etc., trying to stay a step ahead of the market and help people make a little coin and discover some trends and invest for some profit and some joy. You can search my name on Apple, Google, Spotify. Get the Panic with Friends podcast, Howard Lindzon. Subscribe, tell your friends. We rarely do these type of shows where they are just about the moment in time. We try and make evergreen content. But in moments like this, like I said, where we think there's something going on that's worth paying attention to in the markets, and we are definitely, my spider tingly senses are there at the moment. I think that's what is important to chime in and tell people there's some opportunity out there. One other thing I was going to tell you, Knut, before is that as I get older and try and battle my nerves, and young people listening, and there's a lot of young people that listen, it's normal to panic. Like you see your account losing value. Happens to everybody. The idea is to book a little profits when things feel amazing, and you can see it in your voice, you can feel it in your spending, you can see it in your thing. To pay the taxes, sell a few things, ring the register. So that to truly manage your fear, you have to have some capital in the bank and zig when other people are zagging. And a thing that I like to tell people, a very simple thing that I've discovered over 30 years is when the VIX, the volatility index, gets above 30, which it doesn't do but maybe once or twice a year, pay attention. Those are the moments that you can look at your screen a little bit more and look for the companies that you really like in the 8 to 80 brands. Because volatility does die down. The world, we had a 4-year period where the volatility was high. Every day the president would wake up and say something that would increase the blood pressure of the nation. It was a very confusing year of 4 years, and it was a very confusing year for the markets. And now we're paying the effects of that. And so when the VIX gets above 30, pay attention. Try and be a buyer, not a seller, but try and be a buyer from a position of cash. Don't go on leverage. But when the VIX is above 30, and you look out 6-7 months, I think if you buy great companies, as painful as it sounds, and you look out 6 to 12 months and forget about it, you will be surprised with the results. So always pay attention to that. The VIX does not move that often. It does not spike that often. We are in that zone for the last month, and doesn't mean in March 2020, for example, went to 90, which was a record. So it is not a foolproof thing. But we're starting to see with the VIX in the 30s and the high 20s and tech stocks down 50, 60%, 70% from their highs. You want to be on the other side of that panic. So hopefully that helps. Like I said, subscribe. You'll get a podcast once a week. Thanks, Knut. Thanks, StockTwits, for distributing. We'll see everybody next week.
Howard Lindzon is the founder and general partner at Social Leverage. All opinions expressed by Howard and podcast guests are solely their own opinions and do not reflect the opinion of Social Leverage or StockTwits. This podcast is for informational purposes only and should not be relied upon for decisions. Guests may maintain positions in securities discussed in this podcast.